All right, let's get right into it. You've seen these stocks, right? The ones that seem to just defy gravity, shooting up and up with what looks like no end in sight. But what if all the warning signs of a huge reversal are actually hiding in plain sight? Today, we're going to put on our contrarian hats and really dig into the bear case for SanDisk, a stock that, on the surface, looks absolutely unstoppable.
I mean, just look at this number. In a single year, SanDisk, that's ticker SNDK, has gone up over 1,200%. That's not just a good run, that is a full-blown market phenomenon. And it creates this incredible sense of euphoria, this feeling that the stock can only go up from here.
And you know, when you see a move like that, the feeling on the street is just electric. The consensus view is that this is the party that will never, ever end. Every little dip gets bought up instantly, and every new headline just seems to pour more gasoline on the fire.
But that's exactly why we're here today. We're asking that kinda uncomfortable question. What happens when that gravity check finally arrives? Are there some bigger forces at play here that this super excited market is just completely ignoring?
Okay, so let's start digging for some clues. And our first stop is going to take us into the pretty complex world of the options market. This is a place where something that looks like a massive sign of strength might actually be a hidden trap, just waiting to be sprung.
So at first glance, this is just wildly bullish, right? A whopping $56 million being bet that the stock is going to keep soaring. But here's the twist. What if this mountain of optimism is actually setting the stage for a massive trap?
Well, this is all thanks to a really fascinating market dynamic called a gamma trap. Now, it sounds complicated, I know, but the basic idea is actually pretty simple. The very things that market dealers have to do to manage their own risk, well, those actions can actually end up causing a huge, fast move in the opposite direction. So how does this trap get sprung? Well, it all starts with a huge flood of these speculative call options. Then, as you see in step 2, the dealers who sold those options, they have to hedge their own risk. And they do that by buying the actual stock, which, guess what, pushes the price even higher. But, and this is the crucial part, step 3, if that upward momentum stalls out, those dealers suddenly have to unwind all those hedges, and that means they start dumping the stock, which creates this vacuum where all the buyers just disappear, and the price can absolutely plummet.
So that idea of a stall we just talked about, well, that brings us directly to our second clue. Are there already signs on the price chart that this incredible rally is just running out of gas?
And this chart, wow, this is just a classic signal of exhaustion. So on the left, you see the stock price, and it's hitting these exciting new highs. But look at the right. An internal strength indicator called the RSI is actually making lower highs. This is called a negative divergence. And it's basically like the engine is sputtering, even though the car is going faster. It tells you the strength behind this big price move is kind of rotting from the inside out.
And if that wasn't enough, we've got this. The recent launch of a brand new 2x leveraged ETF, ticker SNDU. Now, historically, this is a legendary contrarian top signal. So why is that? Because it creates something called exit liquidity. Essentially, it brings in a rush of really enthusiastic leveraged retail buyers, which is the perfect opportunity for the institutional investors, the smart money, to sell their huge positions right at the top of the market.
Okay, so we've got a potential options trap and we've got technical warning signs. Our third clue takes a look at the story itself. Has the narrative that's been driving this stock already hit its absolute peak? A point where anything less than perfection is just a huge disappointment. And the story is so powerful, so simple. It's that we are in a NAND supercycle. Demand for memory chips is just off the charts, prices are surging, and SanDisk is right in the middle of all of it. I mean, it is the perfect story to make a stock go parabolic.
But this quote right here, it just perfectly captures the danger that's baked into that story. See, the memory business is famous for being cyclical. And as the quote says, high prices are the cure for high prices. What that means is, when prices get this high, it encourages massive new production and makes big customers think, maybe I'll wait to buy. Sooner or later, those super high prices cause their own downfall.
And this is where that whole story becomes so fragile. The market is already expecting a mind-blowing 90% price surge. So what happens if it's only 80%? We're also seeing signs of what you might call capex fatigue from the biggest buyers out there, like Microsoft and Google. If they pull back their orders just a little bit, this market could flip into a supply glut practically overnight. And in this business, cycles don't just drift down, they crash hard.
So we've looked at the options setup, we've seen the warnings on the chart, and we've analyzed the risk in the story. Now let's put all these clues together and look at the final piece of this puzzle, the valuation.
Is the stock's price fundamentally disconnected from any kind of financial reality?
So get this, the stock is trading at a price-to-sales ratio of 10.8. For a hardware company, a company that, by the way, was unprofitable not that long ago, that is what analysts call nosebleed territory. It assumes absolute perfection for years and years to come.
So, the market, in all its collective wisdom and excitement, says the price should be
$720. That is the price of pure euphoria. That's the price of the perfect story playing out exactly as everybody hopes. But what happens when you strip out all that emotion and just run the numbers through a more conservative financial model? Well, you get a very, very different picture of reality.
$158. Now look, this is just one model. It's not a crystal ball, but it highlights a gigantic gap between the sentiment and the fundamentals. It suggests the current price includes a premium of over 300% based on euphoria alone.
At the end of the day, it all comes down to this really powerful idea. The market is kind of like a boat. And right now, almost everyone, from the retail traders using leverage all the way up to the major institutions, they are all crowded onto the bullish side of that boat.
And so, the crucial question we're left with is this. When the boat is that heavy on one side and the expectations are that high, what does it take to tip it over? A small shift in the wind? A single wave of bad news? That is the gravity check.